Thanks for joining us on Parlance. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get you the headlines. Indian equities remain subdued, weighed by selling pressure on financial stocks and metal companies. IT stocks outperformed.
48 out of 52 economists polled by Bloomberg expect the RBI Monetary Policy Committee to maintain status quo tomorrow.
Sun Pharma shares remain under pressure despite Dilip Shanghvi's attempt to allay investor concerns. Shanghvi maintains that the company hasn't received any communication from SEBI.
The government-appointed IL&FS board is cutting manpower and shutting down some offices for cost optimization. That's according to a second progress report. We'll get to that in just a bit. A quick check on how the markets are faring. Neeraj is here, as always, to tell us what's going on.
Hey, afternoon, Harsha. So about 1/3% off for the Sensex. We've a bit soft in the session today, and mind you, today, in contrast to what's happened in the previous two sessions, the mid caps and the small caps too are not performing. So a bit of a pullback at the broader end of the spectrum too. You could argue the small cap index is about 0.5%, but the market breadth could have been a lot more positive than what it is. The last couple of days, it was much better. What's doing well within the individual components? I think the headline said it all. The IT names are doing reasonably okay for themselves, and large cap IT in particular, so the Wipros and the HCL Techs of the world have a decent enough showing in the session today. TCS is not doing all that badly, so it's that IT pack which is doing well. Non-index, I think the small finance banks have had a fabulous move in trade today. Ujjivan Financial, Equitas Holdings, the two of them at least are rock solid in trade. They've started off well and they're staying higher on fairly decent volumes as well. So that's a pocket of strength in trade. IDFC Bank and Capital First, the duo, both of them up about a couple of percent, or rather 4 percentage points. So that is not doing all that badly. Select financials have come off. So HDFC, Canfin Homes, DHFL, and a couple of others have pulled back. OBC is down about 2 or 3% as well. So that's a clutch of names that have just come off a little bit in trade. Last but not the least, watch out, commodities have a mixed bag of trade today. Jindal Steel and Power could have done a lot better, but not quite doing that, about 2.5 to 3% lower. So that's the other one. And of course, keep on watching out for the FMCG names. HUL, second in a trot, didn't have a bad outing.
Neeraj, thank you for that. That's the markets for you. The focus has now shifted to the RBI Monetary Policy Committee, the meeting that's underway. While an overwhelming majority expect the 6-member panel to stay put on rates tomorrow, Ira is standing by to take us through some of those factors at play this time. Ira.
All right, as many analysts have pointed out, there's a sea change in the environment against which the October MPC review was conducted and the December MPC review will be conducted. So cut the MPC a bit of slack on some changes in analysis because the environment is entirely different. Let's look at some of the swing factors. Most importantly, it's going to be crude oil. If between the August policy and the October policy, crude oil was up 15%, since then it has tumbled down 20%. Who could have predicted that, right? So the concerns on higher crude oil prices feeding into inflation, those will be to a touch on the back burner right now. Same story, similar issue on the rupee. The rupee, which had depreciated to record lows between the August policy and the October policy, has now appreciated and is trading at about 70, which people believe is a comfort level. But again, the concerns about imported inflation, some concerns about interest rates being used as a lever to tackle the current account deficit, all of those sort of chatters, again, at the backdrop this time around and not as important for the MPC to be looking at. Of course, their mandate is inflation, so a lot of attention will once again be focused on inflation. But here again, there is a change in the environment because you have continued to see inflation underperform expectations. Food prices have remained one big conundrum as to why food prices have been so soft, but what that has done is kept the headline inflation in check. Now, granted that the core inflation numbers remain elevated, but remember, in the inflation targeting regime, you are targeting the headline inflation. So to what extent can you sort of justify acting on behalf of core inflation? That's something that remains to be seen, how the MPC actually justifies it, should it feel the need to continue acting on the inflation front. But at headline 3%, I don't think anybody believes that another rate hike is required. Also, you've got another round of GDP data, and that too has told you that growth from an 8.2% print has come down to 7.1%. So keep all of those factors in mind, and you know that there is very little reason to believe that there will be another rate hike, not just this time around, but at least going by the factors that we have at our disposal right now, any time in the next few months. So no surprises that most analysts on the Bloomberg poll are suggesting a hold call. There is some talk that perhaps the MPC needs to move back to a neutral stance, but nobody believes that it will happen this time around. Should the factors that we highlighted remain very dovish, then maybe in February or so there will be that debate about moving back to a neutral stance. But it could be a fairly uneventful policy this time around from the perspective of monetary policy. Liquidity is the other thing that has been talked about in the run-up to the policy. But again, if you look at the absolute end of this chart, in the last few days, liquidity conditions have also eased. The RBI has said it will continue open market operations, 40,000 crore to be infused via open market operations in December. They've been putting out calendars, so they've been communicating to the market as well. And the fact that they put out a calendar for December now makes it less likely that a cash reserve ratio cut is on the table. There was some chatter that that may be something that could be discussed, but it looks relatively unlikely. That's on the monetary policy front, so expect a fairly uneventful policy in some ways, although of course there's a whole host of other issues that we will be hoping to hear from the RBI management on.
Let's talk about one of those issues. The dovish member of the Monetary Policy Committee, Ravindra Dholakia, has raised questions about the efficacy of India's inflation data. In a recent article, he's argued that there is an urgent need to modernize the methodology. Anirban Nag of Bloomberg News is here to look at what is India's inflation conundrum and why this debate is relevant right now. Anirban.
Absolutely, Harsha. The issue, what Mr. Dholakia, who's one of the most dovish members of the MPC, says is that the inflation index right now is not chain index based, which means that it's not representative of the consumption trends which keep changing. So what he's telling is that you change it to a much more modernized way so that we're getting the inflation trends which are in line with expectations and in line with what the advanced economies are. There's a problem with that. The problem is data in India is not exactly very forthcoming and very
and comes with a lag.
Yes, that's right. So there are issues there. Plus, the other thing that he raises is the RBI's inflation survey, which the RBI itself does for a lot of the urban areas. Dholakia's point is that you should go into the rural areas also because you have the informal sector there. So he puts both these things in place, as well as the housing inflation. He writes about that too. His main prognosis is that if under an inflation targeting framework, if we don't get the inflation numbers correct, then it will come at a cost later on.
Interesting that. Anirban, many thanks indeed for joining us with that perspective. Well, watch out for the action in the RBI tomorrow.
All right, there's going to be a strong case for the Monetary Policy Committee to shift stance back to neutral, perhaps by February. That was the word coming in from Rajiv Malik of Rio Valley Asset Management, who spoke to us yesterday. He highlighted that there has been indeed a sea change in domestic fundamentals. Listen in.
I think given global developments, including with what's happened to crude oil, and it's literally a sea change compared to the last time round in October when RBI actually stayed on hold but shifted its stance towards moderate or incremental, calibrated tightening is the expression they had used, although I still don't understand what that means. Very few central banks actually define tightening in that manner. But I think there's a strong case for the MPC to actually shift stance back to neutral. I would be surprised if they do it this week, simply because central banks or MPC don't want to swing about those magnitude of changes. But come February, there's a pretty strong chance that they will shift to a neutral stance once again. Don't forget, staying on hold this week is still very much consistent with the initial guidance that the MPC has given, because basically it means they stay on hold or they raise rates. Raising rates in the current environment seems to be a pretty low probability unless once again we see a massive reversal in the kind of favorable news flow we've seen recently.
Rajiv, where have they gone wrong? Have they gone wrong in their understanding of inflation, or is it just the headline number being thrown about by the food price scenario, which then leaves them to have to dissect it into core inflation, what is real inflation and what is just headline inflation movements?
So there are a couple of factors. Ira, first off, I think the only way one can get a forecast right consistently all the time is by not making one. I think all analysts will realize that they've got stuff wrong or off from time to time. Analysts don't necessarily face the heat as much as central banks do. The second point really is I think the most puzzling aspect has been the well below trend food inflation. Now, it's easy for the government and many others to crow about that, look, this is a sustained downshift that has taken place. I'm not totally convinced. I mean, you can't have this level of food inflation given the distress in the agriculture sector, in the farm sector. So unless we think that's going to be the new normal, we really can't take the food inflation numbers at face value. If you believe that, plus if you put in context that core inflation actually has been exceptionally high, and even if we see some rolling over given what's happened to the commodity complex, it is still pretty high. So, you know, if you're a policymaker, the fear you would have, and you're looking beyond just a few months, is that if there is once again unexpected jump as far as food inflation is concerned, what does that do to meeting the target on a sustained basis? I'm not talking about next few months, but really from a longer term perspective. And I think that is where some additional clarity from the MPC or members about how they think about food inflation would actually be rather useful.
And also, I think Ravindra Dholakia, for instance, has raised the question as to whether the dynamics of inflation in India have changed, whether the inflation targeting framework has already had some bearing. He'd written in the EPW about this. The central bank probably needs to study inflation a little bit more.
I think that's a fair point. There are always different variations. If you recall, at a much earlier time, the whole issue about protein-driven inflation was something that had actually been pointed out by RBI's research, and that's when the markets and analysts also jumped on it. So I think we need some more clarity, some more digging in deeper, etc. I should point out, you know, this talk about inflation dynamics having changed, bear in mind, I mean, just a few months ago, everyone was worried about inflation picking up. And in fact, RBI, MPC actually tightened twice consecutively. So I think there are many flip-flops that are happening globally. Oil prices are a very good case in point. But equally, I think part of the soft patch on inflation that we are seeing is also a function of growth not having picked up as quickly or by as much as people were anticipating or wishing for. So the real test of is there a new normal for inflation, new lasting normal for inflation, will really be if the economy is chugging along quite well and the MPC is able to manage inflation within its target range. We are not there yet, and we may not be there for some time. So that would really be the real test of whether or not inflation dynamics have changed.
Rajiv Malik on inflation. Let's move on. More corporates are choosing to offer overnight securities to park their cash. Assets parked with overnight funds jumped more than 2 times from September to November, shows data released by Morningstar. Ranajay Mazumdar of Bloomberg News is here with some details on what corporates are doing. Ranajay.
So, Harsha, what it's really looking like is kind of a fallout from the IL&FS crisis. The Treasury departments at corporate just do not want to take as little credit risk as they possibly can. That's why we're seeing such a big increase in demand for overnight funds. These funds are not subject to any kind of credit risk, to any kind of rate risk, or to
are you anticipating further demand by corporates?
So in the long term, it will depend really on whether more regulations are brought in for liquid funds. Otherwise, what Kilol Pandya is saying, who's the head of fixed income at SL Funds Management, is that they might become just flavor of the month, depending on whether further regulations are brought in or not for the liquid funds.
All right. Thank you so much. All right.
Thank you.
The government-appointed IL&FS board has put out a second report on the progress made by them to try and find a resolution plan for IL&FS. It lists out some internal measures like trimming manpower costs, and others like putting more assets on sale. Also says that a group-wide resolution is looking extremely unlikely, so it'll be down to verticals then. Joining us with more details is Sajid Manga. Sajid, what does they say?
The second progress report which has been released today morning, it very categorically talks about manpower rationalization, which basically means that they're going to cut down the manpower by 65%. Now they have nearly 4,000 employees or so. So you're looking at a retrenchment of more than 2,000 employees from IL&FS group as a whole. They're also targeting the wage bill to come down by 50%. The wage bill as of FY18 was somewhere around 1,100 crores odd. So they're looking savings of 500 crores that will bring in cash flow for the sustainability and liquidity for the group. Over and above that, they're looking at a couple of operational rationalization, which basically means that they're shutting down offices across India, many of the offices, and putting them on lease or selling them off. In Mumbai, they're looking at renting out its IL&FS financial center on lease, so that will bring in some 20 odd crores. They're also looking at some asset monetization of non-core assets like cars and others. They've already done away with the guest houses leases, which were the controversial ones, which are there, and some of the early superannuated consultants which were there. So that will bring in some savings of over 100 crores or into the entire picture. But what it very categorically states that the review isn't over yet. There are over 342 companies which the group claimed at the NCLT. Of that, they have been able to review only 165, and of that, hundreds have a gap of cash flow, which basically means that they're going to default till March 2019, and because there is a cash flow deficit which is going to come in there. It is from various companies ranging from IL&FS to its road subsidiaries to its overseas subsidiaries. It's renewable or the energy business which is there, or the skill development companies which are working on that. Remember, they have already put two companies on the block. One is the securities business and the second one is a renewable business. They have got some interest from investors, but this entire process will take at least 3 to 6 months before it gets completed. And what they're indicating is that now they have to go company by company to ensure that they have liquidity and cash flow position intact for those companies or entities going forward.
That's probably likely to continue even till March 2019.
It will go beyond March 2019 as we see from now.
Okay. Thanks, Sajid, for that. Meanwhile, the Mumbai NCLT has issued restraining orders to 9 former top executives at IL&FS. The tribunal, which was hearing the government's petition, has barred all of them from selling or encumbering their movable and immovable assets. Riddhima Saxena reports.
The Serious Fraud Investigation Office report that was submitted to the NCLT found that the 9 officials that are now being restrained from selling or pledging any of their personal assets were also the key decision makers for the holding company and its subsidiaries. This, according to the report, led to undermining of the interest of the subsidiary companies and associate ventures, which acted only as departments of the holding firm rather than functioning as independent separate entities. The report also alleged that the top officials at the group showed profitable and decorated financials which hid the depleted financial condition of the holding company, as well as this was done to avoid breach of regulatory ceiling to create leverage on the company's books and also to obtain high credit ratings. The report also found that 46 overseas subsidiaries of the companies could not be located or had ceased to be subsidiaries of IL&FS, for which the court has asked Ministry of Corporate Affairs to submit a detailed affidavit on how these companies had vanished within 15 days from December 3rd.
Sun Pharma investors don't seem to be convinced with Dilip Shanghvi's explanation of the various corporate governance and insider trading allegations that have been levied against the company and its promoters. The stock is trading lower despite the promoter holding a conference call last evening to address some of these issues. Darshan Mehta joins us to take us through some of the responses provided by the group. Darshan.
Yeah, so there were almost 7 to 8 or probably 10 concerns that the investors had requiring, and Dilip Shanghvi had made clear that he is addressing concerns because of the Macquarie sales note and the PTI copy that came in terms of the whistleblower case. Now, out of all of them, there are 3 concerns which stood out. Most of the others, including why Sudhir Walia is not a promoter and why some of the share of some of the auditors which have had issues in the past with regulatory issues. Auditors. So that was pretty clear and that was out of the way. There are 3 things I want to point out and where the market concern is there. First one was the whistleblower case, which the brokerage community believes will be an overhang on the stock. Dilip Shanghvi said that he does not have the copy, he does not of this 150-page whistleblower report. SEBI has not contacted him. SEBI has not even contacted him for reopening the case, nor in terms of this whistleblower. So they're saying he does not have any comment to offer on this, but the brokerage community believes that this will be an overhang on the stock going ahead because no one has any clarity on what this is. Second query was on this Aditya Medisales. Now this is a group company by which the entire domestic business of Sun Pharma is routed via analyst, and this is a known fact that this is done, and Macquarie's sales note put that why is this being done. What has happened is Dilip Shanghvi said that at this point of time the entire business, but the scale of business is very small. They are saying that just 0.4% of Aditya Medisales makes 0.4% PAT margin, and he says that it's not very large and then does it as per the scheme of the other wholesale businesses does. He says that it was consolidated only in FY18 and not earlier because of the change in shareholding pattern, but he is open to make changes. The 2 options he gave, that either Sun Pharma will take over the distribution or buy out Aditya Medisales at cost. So that's the second thing where is open. The third is the important one where if you look at the annual report, they've given loans to almost worth 2200 crores to unrelated party, and that is where Dilip Shanghvi couldn't clarify. Despite several times asking him, he refused to name the person to which this was done. He said it's done only on the pharmaceutical, someone who has been doing pharmaceutical business, but it was done at an arm's length and at a market rate. It was a loan given for 2.5 years, and he says that he expects to comment back, but the comment that he offered was that in case there is shareholder activism and they believe that this should not be done, they are looking to reverse this loan. So these are the 3 areas wherein an overhang will remain and grey area will be there, and that's why probably despite all the other clarifications, there is some bit of issue with Sun Pharma share price today.
Darshan, thank you for putting that in context. That's Sun Pharma, and that stock is taking a beating today as well. Unilever will buy GlaxoSmithKline's consumer healthcare business in India and merge it with HUL in a deal worth $3.8 billion. Agam is here to talk us through the deal contours and who gets what out of this deal. Agam.
Harsh, I'm going to start off with some clarifications that the management has made yesterday through its conference call. Firstly, that its brands Boost, and Maltova and Viva will be owned by Hindustan Unilever, whereas Horlicks will be owned by its parent company Unilever. And for using Horlicks, Hindustan Unilever will pay a certain royalty to Unilever that will come to around 1.75 to around 4.25%. Moving in terms of the pros for the deal, a lot of analysts are of the opinion that GSK's consumer business will give Hindustan Unilever's food and refreshment business that scale. Of course, it's not really present in the health foods, business, and that, of course, it turns out to be an advantage. Horlicks present in about 20, its penetration in the Indian market stands at around 24%. In rural markets, it's even lower at 14%. So it indicates that not only does it dominate these markets, but also there's a lot of scope for growth going forward as well. And of course, together, once Horlicks becomes a part of Hindustan Unilever, their foods business will be 10,000 crores big, and that's among the few pros that the analysts have been talking about.
So what are the challenges that the merged entity will have to face?
Oh, well, there has been a slowdown in HFD in the last few years. That's one thing. HUR doesn't have the expertise to deal with the health and food drinks business at this point in time. And we have seen a little bit of slowdown, especially if you consider the CAGR for GSK's volumes growth. That stands at 3% as against HUR's 5%. And let's not forget, we are also looking at EBITDA margins for GSK peaking at 24%. That's largely on account of raw materials tailwinds coming through. And we also have the overhang of the sizable share of GSK which they will sell once the completion of the merger comes through, and integration issues are among the many other challenges. But on the whole, as far as the street is concerned right now, they are of the neutral to a positive, well, their view is of neutral to positive, and yeah, largely constructive on the deal itself.
All right, Agam, thanks so much for that. Energy drinks could get costlier. The Finance Ministry is contemplating levying a higher tax and cess on caffeinated energy drinks, according to two officials aware of the development. Nikunj Ori, who has reported this story, joins us with the details. Nikunj.
The government is considering to impose compensation cess of around 12 to 15% on energy drinks that contain caffeine, like Red Bull and Monster Energy. Currently, there's no compensation cess that is levied on such drinks, and these energy drinks are classified under the segment of non-alcoholic beverages and attract only a GST of 18%. Now, the proposal is to include energy drinks under the ambit of GST compensation to States Act, and also to increase GST on energy drinks from 18% to 28%. Now, this proposal is being considered to remove the anomaly that cold drinks attract a tax of 40%, that is 28% GST and 12% compensation cess, while energy drinks that contain caffeine are taxed at only 18%, despite warnings being issued on their consumption by World Health Organization. Now, this proposal will be considered in the next GST Council meeting, and the amendments to the Act are expected to be tabled along with other budget proposals. This move of increasing GST and also levying compensation cess on energy drinks is expected to fetch around 150 crore rupees to the government.
Nikunj, many thanks for that. Out of time on the show. Thank you so much for joining us today.